Hey guys, John Polemy here, Actionable Intelligence. Today is Saturday, December 2nd, and this is the weekly market update. The disclaimer, as usual, anything that you hear or see on this podcast or video is not to be taken as investment advice. I am not a registered financial advisor. I cannot give you individual financial advice. Please do your own due diligence and your own research. It's your money. It's your responsibility. Okay, so back from the break from Thanksgiving, I was going to put out a video, but then circumstances occurred such that I couldn't. And so we're back, and this will be a little bit longer because we have of a show this week, just because of the fact that trying to catch up with some of the great information. A lot of good stuff came out this week. Want to start off with one of my investing heroes, Charlie Munger, died recently in the last week. Guy was 99 years old. But, you know, when I decided many years ago to try to go to the well, so to speak, and instead of trying to reinvent the wheel vis-a-vis investing or trying to determine what works in investing, I decided, you know what, let me try to figure out who some of the smartest people are that have been most successful over long periods of time and see what they say about it. And so one of those people ended up being Charlie Munger. Some people like Charlie Munger, some people don't like him. Some people, that's just how it is. But I found him to be a pretty wise guy as far as he's probably a genius level. It's not something that you can just, if you read a couple of books about him or listen to a couple of his videos, you'll be able to become the next Charlie Munger. He had a lot of wisdom. He was probably, like I said, genius level IQ. I think a couple of things that I would take away from him that I think from his wisdom that really made an impression on me. And they're simple things, right? It's like things that we used to be taught when I was younger, being in my 50s, and that what my parents and grandparents taught me. Things like, pushing gratification off into the future, living a normal life. One of the things Charlie would say is the three things that get people in trouble in business or investing is, liquor, ladies, and leverage. And, I don't think it needs any comment. If you're going to delve into drugs and alcohol and partying and all this stuff and waste time and become, addicted to substances, you're probably not going to have success in life. And, if you pick the wrong life partner, or if you're out there doing certain things and you end up, being married and divorced several times, that's going to hinder your progress. And, using excess leverage. So he was all about being prudent, putting self-gratification into the future, not going into debt. These are all like, he said that you have to like deserve your success. And how you do that is by living your life a certain way. Now you could take that or leave it. Some people will disagree, but I think that some of these things were very, wise. Now, some people don't agree with him because they say, well, he was an old guy, like on cryptocurrencies. He said that people just, that were trading cryptocurrencies are just trading turds, so just because somebody is, that doesn't mean every person that's good at the craft of investing gets it 100% right. And so that's why people will pick apart. But I think overall, you know, if you go and look at his advice, and he was a very prolific speaker, many videos, many books about him. I recommend getting the what I think is interesting is the Poor Charlie's Almanac. It's hardcover. It's on my reading list. You can find it in the show notes and buy it. But I think it's an excellent book that goes through the wisdom of Charlie Munger. The other thing that I liked that he said was, I think that's very important that, and this comes back to, like I said, deserving your success and putting the work in, is that he said that both him and Warren Buffett were voracious readers. And they took in large amounts of reading and information, and this helped to create these different mental models or give you insight. I think it's interesting that he said to a class of graduating MBA students at Stanford, I believe, one of the graduates asked him, what's your key to success or something like that?" And he said, "Read 500 pages a day." I mean, that's how we say this, like these one-liners. So what does that mean? So does the average person do that? No. Does the average person even read one book a year? No. And I'm not talking about reading romance novels or fiction. I'm talking about, all kind the sciences, history, biographies of people, trying to psychology. I mean, all of these things, then it's like compound interest in a bank account or compounding returns over time. You can compound your knowledge over time. And you have to do that to be successful. That's one of the things I didn't even know about, but I've been a voracious reader my entire life. And people are like, seem to be amazed because they'll say, "Well, how do you know that?" Well, I read. I don't say anything. I just, well, I know this, or how do, I don't have competence in all of these different disciplines, but I can speak or understand different things that the average person has no concept of just from simply reading. I mean, with the advent of the internet, if you're somebody that likes reading or likes to take in information, I mean, you could take literal college courses from MIT and Harvard now online. So there's really no excuse. And I think this Jesse Felder tweet kind of sums it up, right? And I hear a lot of crybaby stuff. You've got $200 trillion of GDP descending on planet Earth every year. And so all these people are saying they can't do anything. It's so horrible out there. And they're living in the United States of America. They're not living in Equatorial Guinea or Myanmar or enlisted in the Syrian Arab army or the Ukrainian army and on the front line. They're in the United States and, or Canada or Western Europe saying, "Woe is me, I can't make it in this world." I don't buy it. And I kind of revert to the old school way of thinking. What I have found when I have looked at these people and tried to help them, um, a lot of times they need to do some self-introspection and look at where they're really, how they're conducting themselves in life. But I think it goes back to what it says here. It says, "If Charlie Munger didn't quit when he was divorced, broke, and burying his 9-year-old son, you have no excuse." And a lot of people are going to, disagree with me on that. It's different now. It's not different now. I mean, it was the same thing when I was in high school. I didn't have the money to go to college. I look at the opportunities. I had a jet engine metalsmith apprenticeship that I was going through that I had completed. I could enter the workforce there, or I could have ended up going into the Navy and starting there, getting a trade. And what I found is the same thing: showing up, putting in the time, and doing it. I mean, I knew of a kid that started at McDonald's when he was 15 on fryers. Everybody made fun of him on Friday night. He's working at McDonald's, fry guy, all that stuff. Ha ha ha. Well, the guy is a multimillionaire now and is like a big shot in the McDonald's system. There's something about putting your time in and letting things compound over time. But enough on that. Like I said, there's many things that you can disagree with what that Munger said, but I just found him to be a very wise person. And I think some of the suggestions he made about how to be a success, not only in investing in life, are very applicable. And anyone that chooses to adopt some of his good habits, I think will find that they will get great benefit. So rest in peace, Charlie Munger. And like I said, the good thing about the internet is he will live on YouTube and in various books and websites and that type of thing. All right. So we had the COP28 CO2 worshipers meet in UAE. The only thing I really want to take away from this is that I think is something tremendous that came out of it. I put in the title 28 countries agree to triple. It's actually 22, but I think there's some more that added on since this. Anyways, the bottom line is that, nuclear power is back. There's a commitment now to increase nuclear capacity 3 times by 2050. It's the most ambitious nuclear capacity expansion ever that's been announced ever. And so we said we would end up here. If you remember way back, if you've been following my videos for several years, you can recall that I've always been an advocate for nuclear power. I've always said that nuclear power will be the panacea to a lot of the energy issues around the world, and also for the climate worshipers, that in the end, all roads lead to nuclear power. Originally, I was laughed at, told I didn't know what I was doing. Nuclear was a dying industry, and all the other canards. And it was obvious this is where we were going to end up. And so I think I will say that, in getting involved in investing in uranium and nuclear power way back then, 3, 4 years ago, even, it's changed my life financially. It's added zeros to my net worth. Do I think the same opportunity exists then as or now as then? No, obviously we've had tremendous increases in prices, but I don't think the rally's over. We're in a bull market for uranium. You will note that capacity is going to increase for plants and stuff, and who knows how many of these plants will ever get built. The main thing to focus on is the change in the perception and the zeitgeist, which is pro-nuclear now. But you're not seeing any announcements of any new mines coming online. I think there was a mine that came on, an ISR mine in South Texas. I think it was a smaller company, EU. I can't remember the name of the company this week. So I saw that announcement. I think that's going to be, several £100,000 a year or something, but it's a drop in the bucket. We're just not seeing the necessary expansion in new uranium supply to fuel all these reactors. And 2050 is not that far away. It's only 27 years. And, with the timelines for mining and approvals and the reticent nature of many governments to not want to approve new mining, particularly uranium mining, we will see. It'll be interesting to see how this gap gets filled. Again, we're making not all-time highs, but new 52-week highs in the spot price. We're well into, we're above 80 now, and we really haven't seen the blow off top. I think you'll just continue to see the price of uranium march higher, attract more capital, and eventually, something's going to happen to catalyze it to go parabolic. I'm not going to be one of these people that says $500 a pound. Who knows? I mean, I think we'll break the all-time inflation high on a spike, but I really don't know. It's impossible to really know. The market is so opaque. Even with a market that you have a lot of information in, like the oil market, it's difficult to forecast prices. So I think that you just stick with the overall general view that supply and demand are mismatched. That's what I've said for a couple of years now. There's not really much more to talk about. I don't see a lot. I see the demand constantly increasing, the tailwinds of new demand, and I just don't see the same amount of news flow for new supply. Eventually, the price will rise sufficiently that will cause massive investment and new supply. Uranium is not scarce in the ground. We know where a lot of uranium is. It's just a matter of getting the price to a sufficient level to entice the requisite capital to exploit those resources. I just think this is tremendous news. It's just, this is like the cherry on top of the sundae for 2023, and I expect continued good news into 2024 and continued. This is kind of starting to remind me of what happened in the previous uranium bull market. You just saw price of uranium just creep up, week after week, month after month, relentlessly, and the share prices end up following. So this is tremendous news. I wanted to show this. Like I said, I've been an advocate for nuclear power. I think that instead of focusing on trying to bring microchip technology back to the U.S., what the United States should focus on, and I've said before, like some type of program, almost like the space program, something very ambitious, like building 1,000 megawatt reactors in the next 10 years or something crazy like that. And that, just the amount of high-paying jobs, ancillary industries, manufacturing, high technology, operations jobs, engineering jobs, STEM jobs, all the things that would go along with that. and yet we're trying to. This is an industry that we could dominate worldwide. We have the technology, we have the brain power here, we have the ability to do that, and yet we're focusing on importing Chinese solar panels. But again, and we're just giving up, a tremendous opportunity here. You see here to the right of this slide, it says China is building 22 reactors, U.S. is completing 1 reactor, Vogtle 4. China plans to build 10 more reactors. China can build 8 to 10 reactors a year. Building Vogtle 3 and 4 took 14 years, and then it's talking about this Finnish reactor. I can't pronounce it, Olkiluoto or whatever, 3. It took 18 years. So that just takes too long. We need streamlining of the NRC, the approval process, standardized designs, maybe 2 designs that you can pick from. We need the United States government, if they want to get behind and throw money at something. But again, this is, you have vested interests in Congress and in the bureaucracy. And this is why, in one nature, you have a country like China. Well, the CCP decides in a 5-year plan what's it going to do, and it's not subject to democratic influences of 2 and 4-year election cycles. I'm not saying that's good or bad. That's just how it is. And so hopefully the United States will wake up. Hopefully we will grab what was our initial, we were the kings of nuclear power in the 60s, 70s. I don't know why we got away from it, we listened to a lot of people that weren't correct in their assessments. But regardless, the rest of the world, this is where they're going. I would note right on here that they don't even have India on here, and that's going to be another big builder of nuclear power plants going forward. I think I like what it says here. It's time to get serious about deploying new nuclear capacity. So we'll see. This is a slide from the discussion with Sprott. Asset management CEO says utility restocking, low supply sparking record high uranium prices. They were talking about the size of the Sprott Asset Management for the uranium trust have reached $5 billion, up from $630 million. So you see, there's been tremendous amount of flow into uranium. The ETF, also the price rise. Here's a quote here. It says, I think it is important to note that a lot of the price move that we've seen this year is really being driven by utilities who, for the most part, are finally starting to restock inventories. That is our long-term thesis, that a 10-year period of destocking is behind us, and we are now going to enter a multi-year period where utilities are going to contract at a replacement rate, if not restock a little bit. Goes on to say in another snippet here that I put up here, quote, people don't have any inventory to sell. Some days that is because people are waiting to find out if they are part of a winning bid for an RFP until they have clarity that the material they have is going to contract. They hold the material until they get that outcome. So this isn't the only source. We've heard this many times now that there just isn't a lot of material out there. I think it's interesting to note how we've heard other people speak about this too, that a lot of the fuel buyers and utilities really still haven't woken up. They just think that they're always at some price that material will be there. I'm more of the view now that it's going to be a musical chair situation. And I think that a lot of people are, especially foreigners, i.e. China and these other countries, UAE just signed a big deal the other day, I believe with Kazatomprom, that people, energy security, making security of supply and making sure that with the constant flux in the geopolitical situation around energy, that they have sufficient material contracted so that they don't have to shut down these billions-dollar investments for lack of material. So I don't think that the market has reached that view yet. I think when it does, that could be a catalyst for a super spike because, again, we know that the price of uranium as a percentage of the actual cost of the reactor and running the reactor is small. So, if you had, say, $150 or $200 uranium, it's really not that big of a deal in the larger context. which is a different case that if you're running a gas turbine plant or a coal plant, because fuel is such an important and large amount of the costs that go into the plant. Regardless, all this is typically passed on to the ratepayer anyway. So we'll see. I'm continue to maintain my bullish stance and just advocate bond dividends. I like the Sprott ETFs. Yes, I think it's possible to dabble in some of the juniors, but if you look at what's happening, you're seeing more and more of the juniors coming to market and issuing shares. You really need to be cognizant of that, of dilution, especially when share prices run up. You tend to see them, the managements take advantage. It's not necessarily a bad thing if the project is viable or if they're drilling out more resource or what have you. But now it's time, like I said before in a previous video, you can't just buy anything, just throw a net out there because things are so cheap and just consider long-term call options. You really have to look at each individual company. Has this management ever built a mine? What's this management trying to do? Is it just going to sell the resource, develop the resource to a point and sell it off to somebody else? I mean, again, when you go through these different cycles, not all these projects, very few of these projects, maybe one or two actually will come to market and actually be a mine. So I think people forget that. They just get caught up. I see a lot of bias. People get caught up. They marry these things. They marry the story. They know every single thing about every part of the company, and they will just tell you about how wonderful it is. And I'm looking at it and going, there's no way these people are ever going to build a mine. But, that's why I think you're past that where you can just throw the cast net out and grab anything. You really have to be more selective now. And so that would be my advice. Be careful out there. So getting into, we're into, I was a little bit nervous about where the economy was just because I had been advocating for, or not advocating, but of the opinion that the economy was weakening, it would continue to weaken and we would enter a recession. Now, I was wrong about that in 2023. I thought we would already be in recession. I think we are in some industries. Obviously, manufacturing, the PMIs are below 50. They have been. So in manufacturing, I think we are. I think different sectors are in recession. I think overall the economy is not, but it's heading that way. And I think, what I had said maybe 3 or 4 months ago in the summer was that if I didn't see definitive signs that we were entering a recession by the end of the year, then I would have to reassess what my call was. And I think now that we're seeing pretty much, without a doubt, the economy weakening. We if we're not in a recession, we will enter anyone, and I think that will manifest as obvious as we proceed into the new year. The discussion is, I think a lot of the zeitgeist or the view on analysts in Wall Street and financial press is that they've moved from kind of the no landing, or we weren't going to have a recession, into a soft landing. And this is, I wanted to show this charts from Bloomberg. It shows previous recessionary times and how you have a lot of discussion about soft landings prior to a recession. You look at what you see right now, the optimism, what it says here in this top of the chart, optimism tends to peak before a downturn hits. That's where we're at now. It's hope and a prayer. The bottom line is that why was I wrong on my call? I didn't fully comprehend or incorporate the amount of fiscal stimulus and deficit spending that the U.S. federal government had done. I didn't appreciate how much of an effect it had. I was running out, I think we got it right on interest rates. We knew, the lag effect is now, it's like the boa constrictor. Every month it's tightening and tightening as these previous rate hikes now start to work their way into the economy as people try to refinance. You saw what's happened to the housing market. You're seeing what's happening to other situations. But, all those trillions of dollars that were put into people's accounts or given to people, that had a tremendous effect on, basically extending or pulling demand forward and extending the the ability of the economy to not enter a recession. I think that's running out now. I think that, we're running deficits that are, 6 to 8% of GDP. This is wartime levels of spending. It's just not going to be sustainable. And I think there's just a different tact. It's going to be harder for the federal government to do that. And so, again, the QT continues as we speak, monthly 90 to 100 billion a month, I believe, in quantitative tightening. And again, Fed funds rate above 5% and holding, with a lot of people speculating on when cuts will come. Again, my view is very simple. The inflation rate is coming down. It's going to come down further. I kind of think I agree with what David Rosenberg is saying. He's very pessimistic. He says that we could see, inflation down at 1% this time next year. I don't know if it's going to drop that far, but I do think that we'll definitely be able. I mean, where's the impetus? I mean, he asked the question in a recent interview. Where's the impetus coming for growth that's going to reaccelerate inflation? I mean, you're seeing it, weakness in energy prices. You're seeing definite signs of recession in Europe. Europe is in a recession. You're seeing economic weakness around the world. China, is a mess. Japan is kind of slowing down now. And so, it stands to where is this growth going to come from that's going to accelerate inflation? A big component of inflation, of the inflation that gets reported, is in rents. We always knew those were going to start coming down. They are now. It's going to take time for that to feed through. But yeah, we're starting to see now, I mean, without a doubt, the inflation rate has been coming down and will continue. I think that there's no reason why the Fed wouldn't hold rates where they're at until they reach their target. They've been pretty consistent in saying that. A lot of people, including myself, didn't believe them at the start. I think that you have to believe them now. And I think until we see the inflation rate get around their 2% target, or again, if something else comes along to give them air cover, i.e., a dislocation in the banking system, collapse of the commercial real estate market, something of that nature that grabs the headlines, that gives them the air cover to come in and start cutting rates and reversing QT to QE. I think you're just going to see, just like that boa constrictor analogy, just going to see the numbers start getting worse and worse now around the economy. I think that my models that I follow, I'm not an economist. I'm not trying to be one, but everything has been cautionary or is definitely in the red now, just about everything that I follow. So that's it. I just think that's where we're heading. I try not to just cherry pick certain things, but leading economic indicators are down for like 19 months in a row. I mean, you have PMIs now under 50 in manufacturing. I think service PMI comes out next week. If it falls below 50, I mean, how can you say that we're not in recession? So we'll see. There's other things that are happening. I think that people are on the last hurrah, the last throw of the dice, spending money. I have a chart that comes up here later. I mean, TSA screenings at airports were at the record high on Sunday, November 26th. So more and more people are traveling. All the planes I'm on are full completely. So we'll see what happens, but I don't see where the impetus for growth is coming from with liquidity tightening around the world. Now my liquidity model, my central bank model, is starting to reverse. We've had now, after November, 3 consecutive months of net cutting by central banks. We've had more in the last 3 months. We've had more central banks cutting rates than raising, but that's going to take time to work its way through the economy. And those are more periphery type countries or emerging markets, not necessarily countries like the US, Canada, EU, things like that. The big boys are in their pause phase. The emerging markets or some of these other markets that are smaller are on the forefront and have begun cutting rates. So we are into the next rate cutting cycle that will manifest over the next couple of years. But this is why this takes time, though. And so we'll just continue to observe the data. my strategy is very simple. I was in T-bills. I started moving some of the money out further along the curve into 2 years. I've actually had been buying like TLT recently, moving further out into the, excuse me, on the duration, because we've had treasuries down 3 years in a row. You can go back to the free book that I give if you sign up for my email newsletter. What Bob Farrell said, when things go too far in one direction, they have a tendency to go back the other way. So I think there's a possibility that once it becomes obvious that we're having that we are in recession, or if something blows up, the Fed will be quick to, you could see rates down at 3%, and that you could be looking at a possibility of from current levels, maybe 20 to 25% capital gains in long-term bonds next year. Things going down 3 years in a row that's what I like to look at. So what somebody will say now is, well, I would never buy a government bond. Well, I'm not telling you to hold it for 30 years. What I'm saying is you have a trade opportunity. I believe that by the end of this decade, rates are going to be higher. You're going to see rates move higher over time because of the debt that we have and the fiscal situation in the US that's not being solved. But that doesn't mean you have periods of 6 months to a year where, or if the Fed's cutting rates, you can't have a bull market, a cyclical bull market inside of a secular bear market. We talk about this all the time. And so you have to be able to differentiate and nuance these things, guys. So we'll talk about this in more in depth as in the further weeks and months ahead. So record amount of home purchases canceled. Home purchases fall through at highest rate on record in October. So people are signing contracts and then, not following through, probably because they can't get the financing or who knows why. But this is not, again, where's the impetus for the growth? This isn't positive for growth. And this is recession, and recessions, economic activity slows down. More bad news for the housing market. Higher rates equals higher payments. New mortgages, monthly payments. Look at the average monthly payment going back in time. Let's look at that now. This is all attributable to the rate raising cycle that we're in. So this is a reason why people are getting priced out. They can't afford it. Not to mention the fact that housing prices are still too high. Now there are several people that I follow that are tracking this. Prices are coming down in different areas around the country. It's going to continue to happen because prices are too high, because rates are too high. People can't afford it, and we're entering a recession, and we'll see prices come down. We've talked about this before. I think I used the view that was like $400 a month or $500 a month, or not a month, $500 in a checking account. Most people don't have that to address an emergency. Now we have this ability to pay for an unexpected $2,000 expense. This is at a series low. So only 65% of the people in the US have $2,000 for laying around that they can use for an unexpected expense, like the motor in their car blows up, or they need to have a rotten tooth drilled out, or what have you. This isn't positive. So this is a tweet from Jesse Felder. I would follow him if I was on X or Twitter. Says he quotes Target CEO Brian Cornell said, consumers were holding off from making many purchases until the last minute. For example, they didn't buy winter clothing until weather turned cold. Classic recessionary behavior. People are just buying what they have to buy. That's not everybody. Some wag will come into the comments and say, well, that's not what I do. I just buy stuff when I need it. Yeah, because not everybody's in the same position. But in general, this is how we enter recessions, right? When the marginal people that are, lower middle class, working poor, working class people don't feel flush. They only buy what they have to buy when they absolutely have to. When temperatures drop, I can't hold off from buying this coat because otherwise I'll freeze to death. Charlie Munger would tell you to buy your winter coats in summertime when they're on sale, but that's another discussion. So just wanted to point this out, and I've seen this in my own angel investing. I've seen a lot of companies blow up, shut down, startups on the rise. More startups in 2023 are closing doors due to bankruptcy or dissolution. Why? Because the business models are not viable. And with rates where they are, I mean, with zero interest rates, we had a lot of malinvestment, a lot of stupid ideas like specialty vodkas and somebody opening their own, uh, vineyard or what have you. These dumb ideas that, you know, you could, when free money was available, you could do. Now it's different. And a lot of these dumb ideas never were viable businesses. And so they're going belly up. This is another cleansing of the system, if you will, that needs to happen when you have this. And so that this is the business cycle, right? Things that are not viable, things that don't make sense, things that have been malinvestments or ill-conceived, they go away. And the people don't die off. The workers, the management, the capital gets what's left is sold off and goes to other more productive activities. That's the constant regeneration that goes on during capitalism, which a lot of people don't like because they're affected by it. But in the overall scheme of things, this is what leads to higher wealth and productivity. And unfortunately, the central planners in the government are trying to do everything they can over the last 25 or 30 years to disrupt this natural cycle. So for you out there that think that stock prices are just going to keep moving higher, this is a chart that from Bloomberg that talks about, you see the hard landings bring steep losses. S&P drawdowns average 30% in past hard and soft landings. So you're looking at a average stock market decline of 30%, regardless of the type of recession we have. So a drawdown means, the pullback in prices, if you will. And you can see that, talk about all of these different recessions that we had and the type of landing, if you will, they characterized it. And then you see the maximum drawdown that you saw during these periods. So the average was about 30%. So I think it'll be worse this time just because of again, going back to Bob Farrell's 10 rules, one of them being when something goes too far in one direction, it has a tendency to overcorrect the other way, whether on the upside or downside. So is it within the realm of possibility that the market could drop 50%? Sure, why not? I think if and I'm talking about stocks in general, especially these so-called magnificent seven or what have you that are constantly discussed. I mean, again, go back and look at the Buffett indicator, the percentage of the stock market value as it relates to GDP, what he has called in the past his favorite indicator. But we're still historically well above value overvaluation levels that we've seen in the past. We got a long way to come down to get to bargains. And so this is another reason why I'm not really going hog wild into a bunch of companies. I have a lot of companies I'm following on my list that I want to buy their businesses, but when the price comes down, then I will buy them. Right now, prices are still too high. And you make your money when you buy assets, when you buy businesses. So you want to buy them when they're cheap, when there's pain, when everybody's pessimistic, because then the prices are very low. The same thing will happen with houses or real estate. You don't want to buy in a bubblicious market. You have to understand that all of these things are cyclical, right? And you want to buy at the bottom. And so this is where another Mungerism comes in, patience. Can you sit there? That was the same thing in uranium. All the Johnny come latelys are like, well, I haven't really made that much. And you talk about, yeah, because you didn't buy it. Were you buying Paladin at 8 cents? That's when I was buying it. You have to buy things when they're cheap. You don't buy things when they're overvalued. You're not going to get the same return. Depending, your return is determined basically your success in investing of the price that you pay. That's one of the main things that I've learned that's made me more successful. If you overpay, then your chances of being successful in investing are going to be low. And so we welcome these drawdowns. It's not something to be scared of. And like I said, I think that 2024 is going to be a tremendous time to make money in the Treasury market as the recession plays out and as the stock market drops. I think you'll have a tremendous opportunity to sit there, collect cash, and then when the Fed does start cutting rates, then it will be time to come in and start buying these assets on the cheap. And then you just ride the next up wave. This is how things are done. But I would keep this in mind when people talk about, well, it's a soft landing and the market can stay at these levels. If you look at the underlying fundamentals of the market, most stocks are actually down for the year. They're not, you just focus on the average, and that's basically market cap weighted to these Magnificent Seven. Then that skews the averages to give an impression that this overall stock market's up when it's not. So again, with the rate cuts, I wanted to show this chart. The majority of the decline in these bear markets, talking about stock bear market now, occurred after the Fed's pivot, right? So the Fed's not going to start cutting rates until it's obvious we're in a recession, okay? And that's just how it is. And you see what happens on these drawdowns after they begin to pivot, okay? So we have we pivoted yet? No, not yet. We're in the pause phase. But you're going to see, I think, why would you think that the markets would? This is why we talk about probabilities and historical narratives. Could it be different this time? Yes. Anything can happen. When you're putting capital at risk, you have to go on what's the most probable thing that will happen. Okay. Is it a 0% chance that the Fed cuts and things take off? Yes. So that we're actually following typical methodology, because now everybody is keen on the fact that the Fed has paused, and based on what Jerome Powell said on Friday, the markets rallied, a lot of risk assets rallied, but that's just temporary in my view, because the reality of the recession hasn't set in, right? And the lower earnings and all the other things are going to go along with that, higher unemployment, yada yada yada. And so this is something I think that people should keep in mind. If you're betting against history, okay? You're betting against what's probable. If you're going to stay long and get longer in the general stock market, be careful, because your view, especially, you have to understand financial media, financial players, the people in these investment banks, they're all skewed for the market to go up constantly. Why? They want more assets under management. They cream off fees, commissions, advertising on financial media. Viewership of CNBC goes down tremendously, and in Bloomberg during bear markets. Nobody has any interest. People swear off the stocks. I don't want to be involved. Okay. And so they have this same thing if you talk to a realtor. When's the best time to buy a house? All the time. That's what they'll tell you. Okay. Why? Because again, we go back to our Mungerism. This seems to be the Charlie Munger themed video. Show me the incentives and I'll tell you the outcome. You don't ask a barber if you need a haircut. Okay. You don't ask a realtor if you should buy a house. You don't ask your Edward Jones person if you should invest. Okay. They're going to tell you, yes, you should, all the time, because they're going to give you all of these, typical marketing canards. And there's a reason why they get paid. So take this into consideration, please. So cross-border capital, they follow liquidity. World central banks easing. Yes, we talked about that. The last 3 months, we've seen more cuts than increases in rates. So this will continue. We're into the next liquidity cycle. I don't know how fast it will go exactly, but we are there. But again, this is like an oil tanker turning an oil tanker, not a speedboat. So it takes time. It's going to take a year, 18 months, 2 years to really see this. But we're already seeing, like in our Brazilian stocks, they've been cutting rates down there since August. We've seen a turn in some of the stocks that we're involved with, which are mostly financial stocks. And we've been doing fairly well there so far. And so we're looking to those emerging markets. I think that the emerging market cycle is going to look good for the next 10 years. That's just something else we're looking at. I'm looking at, and so far so good. So this is kind of what I think makes sense. This is a chart of U.S. CPI from 1966 to 1982. This is during the period of the 70s when we had the tremendous inflation. And I think we're tracking this, and I think this is kind of the view that I kind of had come to. You know, we're in the process now of seeing CPI come down because of the rise in interest rates and the QT. But at some point, we're going to get to a point where something breaks and they're going to have to come back in. And then I think we're going to see a similar reacceleration of inflation later on in the next few years into the end of the decade. And that's why I think that overall rates will go down in the near term, but they will be substantially higher by the end of the decade. I think this is a similar playbook. Now, it's not exact, but I think it's kind of the same deal, right? And I think you can see, this was a result, these inflations, of the policies of the Vietnam War and the guns and butter social programs that came out during the Johnson administration. And so the money creation, the deficit spending, and all of that caused this inflation. And then, same situation, it gets too high. They have to try to bring it back down, but then it reaccelerated. Okay. So I think this is a similar type situation. We'll have to see if it maintains this, but I think this is a very eerie correlation. And if you look at our present situation, as we move out further into this decade and the constant drumbeat of more and more people getting on Social Security and Medicare, those entitlements, the fact that our economy is over indebted and what that means for economic growth, the changing political situation in the United States towards people wanting more benefits from the government, shall we say. It just points to, like I said before in previous videos, there's no constituency really out there, major one at least, and there certainly isn't, with the exception of maybe one or two people in the entire Congress, advocating for, spending cuts or living within your means. It simply isn't the zeitgeist. And so I think this makes perfect sense. This is why I think that you have a trade in 2024 in longer duration treasuries, but I wouldn't hold them to, I wouldn't hold a 10 or 20 or 30-year treasury till it matures, because you're going to get wiped out by inflation. Again, you can have cyclical bear and bull markets within the context of a long-term secular bear or bull market. And I think you have to be able to understand that and have to be able to take advantage of it, or you are going to get murdered this decade as an investor. Wanted to talk about this. I've been wrong about this. I mean, we've just seen U.S. oil production is at new record highs, and it seems as the more that OPEC cuts, the U.S. picks up more market share and increases its ability to increase production. I've almost pretty much now given up on any kind of short or medium term forecasting of the oil price. I just think it's almost impossible. There's so much information. It's so hard to try to figure out what is happening at the margin. I think more long term. Again, the big money that I made in a lot of these oil stocks and oil companies was when, we had the crash during COVID and oil got to, negative 47. That was your cue to go in whole hog, which I did, and we made a tremendous amount of money. Now it's a little bit different. As the world enters recession, yes, we'll see what happens at the margin with supply and demand. But again, longer term, I'm very optimistic. Why? Because of the insufficient investment. So I think that, again, over the course of this decade, we're going to see higher prices because of the lack of investment. Does that mean in the short term we can't see lower prices? Absolutely. So again, you can't just be a buy and hold type person. You kind of have to really try to understand this, or wait till or wait till there's a setup where it's almost an obvious thing. Like we have, say we were to have a hard landing and we saw oil drop to 60 or 50 or something like that. So again, I did make a call that it was very possible. It was within the realm of possibility that oil could go to 50 before it goes to 150. Well, we'll see. I just think it's just too hard to forecast unless you get to extremes in price on either direction. Then I think it's an easier call. But I think you're probably in a trading range for some period of time, and we'll just see what happens as you know eventually you come out of recessions. Economic growth will recover because of the monetary liquidity that will be injected, and we'll see what happens to oil prices. How high can U.S. oil production go? I mean, I thought that by now it would have peaked. We'll see. Um, we'll see if again if OPEC keeps cutting, and prices stay in this $80, 75, $80 range. That's kind of a sweet spot. A lot of people can make money in the U.S. producing oil. This is a tweet, though. This is kind of what I was alluding to a little bit in the previous slide. We will need every barrel regardless. Just between 2014 and 2024, we've added 900 million human beings to the earth. Yet oil and gas Capex investment hole is near $3 trillion relative to the 2014 trajectory. So you've seen the drop off in capital spending, exploration spending. It's kind of ticked up a little bit, but nowhere near where it was, 10 years ago. And that has resulted in reserve life for, major oil companies has basically been cut in half. And so that's why I think there's an opportunity in oil field services, particularly offshore. I think that eventually this is going to matter, both of these, and we'll see. Again, the oil field services industry offshore has atrophied quite a bit. It's kind of come off boil. There was a lot of excitement there recently in the last, I don't know, 6 months or so. It's kind of come off boil. But I think longer term, again, there's not enough rigs, there's not enough people, and this is, the depletion is relentless, and the demand increases are going to go up, 1 to 1.5% every year. So and this lack of investment is going to eventually exert itself on the market. Wanted to point this out. Chart, what energy transition, global coal-fired generation by region, 1985 to 2022. So it doesn't really matter what you do in the West, okay? Because in Asia, coal use is going through the roof because it enables economic development and prosperity. And so you see, like even down here, like Africa is way down here. You have 1 billion people there that most of which have never flipped not most. Well, I'd probably say most. It's probably well over 50%. Have never even flipped a light switch. Coal's not going away. Coal supply has been contracted because of the psychosis related to CO2 emissions. But again, emerging and frontier markets that are trying to become more wealthy and prosperous don't care what cuckoo people in Western Europe, the US, and Canada think. They're going to continue to burn coal, yet the supply has been constricted. That's an opportunity. Again, you will have cyclical downturns within a longer term, I believe, secular bull market. Talked about this earlier, TSA screening record. This was November 26th, the Monday after Thanksgiving, or Sunday after Thanksgiving. I was traveling that day. It was luckily I had a direct flight, so I didn't have to. Once I got on the plane, we were okay, but everything was delayed by like 40 minutes an hour. Lines were kind of long. But yeah, this is, I think this is the last hurrah, the last shake of the dice for the U.S. consumer. Credit cards, we've talked about this before, maxed out, high interest rates, excess savings down. We'll see though. They've like oil production, the U.S. Has surprised me. The U.S. consumer has definitely surprised me also with their resiliency or their propensity to spend. So we shall see. wanted to talk about this. This is how unemployment kind of goes, right? You think it's going down, and then also when it turns, it kind of turns and goes up rapidly. Um, you have German unemployment at 2.5-year high. We've now had we've got we just had another election. It was in Holland, and Geert Wilders' party came to power, which is another anti-immigration party. I don't know all the other of their stats. I've been following Geert Wilders for about 20 years. He's wants no more Islamic immigration into Europe, specifically, and in Holland. I think you've seen what's been going on over there. These type of attitudes are going to be exacerbated as we see the economic pie shrink. This is just human nature. This increase in unemployment in Germany looks to continue. Obviously, this is not good, as the German economy is the locomotive, the main factor in the EU overall economy. And so when you see unemployment going up for various reasons, basically idiots running monetary policy and idiots running economic policy, I'm not going to get into that. Plus, basically, raising your cost of your energy inputs. What did you expect to happen? And so it's happening now, and people get mad at me. They write me. A lot of Europeans agree they can see this, but a lot of them can't see this, and they get mad. Why are you picking on us? Why are you saying this? Well, you've now had, people see that the political class are starting to wake up and to see that the political class in Europe does not represent them. Okay, it is aligned with the globalists and cares about, what's their next job. Ursula von der Leyen and all these type of people, they're all morons to begin with. They're just suck ups that want to get looking for their next job, whether it's head of the UN or whatever they're planning on doing, and they just sell out their populations. And so you're going to see continual, as I've predicted, social, economic, and political unrest in Europe. It's going to continue and get worse. You haven't seen anything yet. Nancy Pelosi wants to see what insurrections look like. I think you're going to be shocked what you see in Europe over the next 10 years. There's going to be significant changes there, I think, with the possibility of even the EU dissolving. So we'll see. I'm always ahead of these things, it seems. But I think that it goes back to what my dad told me, that Hubert H. Humphrey told him, that when people go into that voting booth, they think about one thing, or the majority of people think about one thing and one thing only. They vote their wallet. Yes, there are single issue voters, but they're not the majority. If people economically are not doing well, then they will vote accordingly. And so we'll see if this continues. I think it will get worse, just because the policies are anti-economic growth. And so the deindustrialization of Europe, and Germany in particular, is happening, and we will see it continue. We've talked about it for a long time, and this was even before they cut their own throats with the cutting off of the raw materials from Russia. It'll just get worse now. So we'll continue to follow this. I'm sorry that if you feel I'm picking on you, but this is the way things are. Facts are facts. So the GMO 7-year return forecast came out. Look at what they're now showing for emerging markets, emerging value, emerging markets, international small cap. This is the place to be over the next 10 years. As I was saying, for over a year, we were early on this. But like I said, we're seeing that now. And look what's showing for U.S. This is what the forecast is for your average annual return. Your average annual return over the next 7 years is negative for U.S. large cap and barely above zero for U.S. small cap. The opportunities are overseas. We see these things happen in like decade type cycles. And so I think that's what we're looking at. And that's kind of where I've been going for the last couple of years. It's now starting to, that fruit's starting to bear. Let's put it that way. We're starting to see fruit on the trees now. All right, that's it for this week. Again, we're back. We'll be back to our normal broadcasting schedule. Really appreciate your support and your patience, and looking forward to a lot of good stuff happening in the next year. And we'll talk to you next week. Thank you.